Hi, and welcome to Macro Monday. When we talk macro, try to make sense of markets that really don't make any sense because they're running on speculative fever, and answer your questions so we can become better investors. I'm your host, Steven Van Metre, and thanks for joining me today because I have a great show lined up for you today. I want to talk about the macro data, and there isn't really a lot of it, but I still want to talk about that. We've got the hedge fund futures positions to look at, the equity put-call ratio, the upcoming Fed meeting, and I am going to get to some of your questions today. At least that's my plan because, as most of you know, I don't edit. So we'll just see where we get to, and hopefully we'll have time. At least I'm prepared to answer some of your questions. So let's jump right in to the macro data that came out over the weekend out of China. And when you look at things from a macro perspective, you're trying to ask yourself, is the economy expanding, contracting, peaking, bottoming? What's going on from a macro perspective? And China is the world's largest exporting nation. So when you see that in May, exports contracted minus 3.3% from May of last year, and imports contracted minus 16.7% from May of last year, it tells you that China is not expanding. In fact, we can look at the previous month data of April and see exports were still expanding, imports were falling, but look at the shift now. And really what this is telling you is, despite what the U.S. stock market is telling us, that the recovery is here and done and over and everything's back to normal, the world is not back to normal at all. And when the world's largest exporting nation is seeing its exports contract, well, guess where those exports go? Well, they go to the United States. So if China is exporting less, that means us and everyone else is receiving less from them. That means the economy is contracting. So far from a macro perspective, what we're seeing in the data, well, we're seeing a lot of disinflation or deflation. Let's go and see what's coming up this week that could be important. And mainly what's coming is on Wednesday. So here we are, Tuesday. Some things to look at is Redbook weekly retail sales. And we got CPI coming out of China tomorrow night. But Wednesday, consumer price index and Fed meeting, we're going to talk about both of those here in a little bit. So let's move on to the futures market and how the hedge funds are positioned. There were some questions that came in. I'm not going to directly answer them. I probably will answer them, but I'll go through in a future video, read the questions appropriately. I want to make sure everyone does get their voice on this show as long as we have the capability. So let's see how hedge funds are positioned, courtesy of hedgeopia.com. And what we can see is 10-year Treasury futures, at least speculatively, increased slightly. Not a big deal, even though we saw this kind of pop in interest rates late last week. Got everyone really excited that perhaps the stock market is right and that there is inflation and the bond market is showing us that. Well, I don't think that's quite what we're seeing yet. How about the 30-year? We see speculators backed off. Now, normally you would expect when they back off that interest rates would go down. But again, they popped this week. They're still very short in these positions. So don't take this as the end of the bond market is here. Remember, interest rates do not bottom until speculators are long. And you can see up here where they bottom. So we got a long ways to go before the bond market is finished playing out its song. How about West Texas Intermediate crude? We can see again a small increase in speculative position. There's a lot of bets on the crude oil market for crude to grow higher. Demand-wise, it's not there. And every week that passes that we lose the summer travel season is not a pretty picture for crude. And even if there was a return in the summer travel season, there's going to be fewer planes on the sky, fewer cars on the road. It's not a good picture for crude oil, in my opinion. I still think crude oil heads, again, much lower as deflation continues to make its way through the global economy. How about S&P 500 futures? This massive short position from the speculators. And what's going on here is hedge funds are actually long what's called the cash market. So when you hear me say cash market, I mean the market that you're familiar with that opens in the morning and closes in the afternoon where people trade. So the hedge funds are very long stocks, and they're hedging those positions in the futures market. That's kind of what you are supposed to use futures for. And so they are hedging to the downside. One would expect they're going to probably try to sell out of their long position somewhere up here. We'll see how that goes. How about gold? We're seeing speculative long positions back off on gold. As we've talked about before, when you see them back off the speculative positions, that means gold prices are headed lower. I think we could see a big retrenchment in gold prices. I know that is a very unpopular position, but I'm going to take it anyways. I still think gold comes way back down due to deflation. And NASDAQ, a small speculative long position from the hedge funds, not much to report compared to their long, say, back in 2016. In small caps, they backed off their longs a little bit. They're still not very steep, but they're moving up there a little bit. Nothing really big here. We know hedge funds are very long the equity market, so maybe perhaps they're pushing this a little higher, trying to drive small caps up to catch up with the large caps. Because remember, small caps do lead large caps, so when they roll over and head lower, expect the large cap stocks to fall. And when large caps are leading the market higher, we'll expect them to slow down and stop at some point because small caps have to be there. How about the dollar? So we're seeing hedge funds back off their dollar longs. Dollar has been taking a beating, and that is partially why we're seeing treasury yields rise. And not quite for what a lot of people expect them to, but more because we're seeing the dollar weaken here. I believe this is a transitory move since there is a massive dollar liquidity shortage, but we'll see how that plays out. And then on volatility, we see volatility shorts got pushed down a little bit as hedge funds look to try to keep pushing the equity market higher and higher. Now I want to look at another chart by Hedgeopia. And before we do that, actually, let's go and switch over to the charting program. And let's go to the S&P 500 and we'll zoom out. See, everybody thinks that this is a new bull market. This is not how new bull markets are born. They don't look like this. They don't move like this. And when we look back here, what we saw was effectively a bull trap. Now, how do we know it? Because, well, it eventually unwound. And that's kind of how you can tell when a market is not in a long-term bull trend, is when you get these major reversal moves like this that unwind literally the entire 2019 gains all in a matter of a month. So what we see here was a speculative rally. We're seeing here an even more speculative rally. Now, how do we know that this is a speculative rally? Well, one of those ways we can do that is to look at the put-call ratio. And Hedgeopia put a great chart out here. It says CBOE equity only put to call ratio, and then has a sentiment survey here in red. And it'd be cool if he had a chart showing the S&P 500 against this, but let me tell you how to read this. So when you see the put call ratio down here at these low points, what it's telling you is there's a peak in the markets. So we should look back and say, okay, was there a peak earlier this year? And then we'll look back somewhere in 2014. And so let's go back to here and say, sure enough, there was a peak in 2014. Let's see. So we got kind of a peak right in here, wherever he's kind of showing that at. Now, if this is a speculative rally, and it is, what you're reading here in this chart is that people are making bets on this market going higher. So they're buying a lot of call options and they're hoping to drive the markets higher. They're not protecting their downside risk. And usually when you see markets get extended with people betting on the upside, they get rapidly unwound. So you can see here, we went from extreme of calls to an extreme of puts. And that's one of the reasons we know this entire rally that's gone on since the lows back here in March is purely speculative. And these speculators are hoping that real buyers come in and put a floor under here, but it's unrealistic that that's going to happen. Now, one of the big confusing things about macro is, how does macro tell you to buy the March dip? It doesn't. See, macro isn't a trading strategy. And a lot of people get that confused when they turn on the show and they're like, well, you missed this or you missed that. look, this isn't a trading channel. If you actually read the disclosures or listen to it at the end, it tells you this is not what this is. Macro is an investing strategy. Well, wait a minute. How is that different than a trading strategy? Well, a trading strategy is something you do day to day, week to week, month to month. You have no commitment in. Macro is something you buy and stay with for, say, a year or more, or several years. Think of it as someone who buys property to rent out. That's an investing strategy. They're not buying it to rent it out to one person to 6 months and sell the property. They're looking to buy it and rent it out for year after year after year after year. And if they buy it at the right time, for the right price, they do very well. That's what macro is. It tells you what the direction of the markets are likely to head. They don't tell you speculative moves or speculative positioning or when to buy the dip. They don't do that. It just tells you what is the trend. And when you understand that, what macro tells you is this here is a major topping pattern. And we knew that because 10-year Treasury yields peaked back in October of 2018 and are still in their bull market. Now, obviously, yields are inverted or shown normally, so it looks like they're falling in a bear market, which they are falling. But from a bullish perspective, yields or bond prices are in a bull market and yields are headed lower. So we know that this is a topping pattern that just hasn't finished playing out. And at some point it will, and the macro data continues to tell us that. But what it doesn't tell us is how many people are willing to bet that this was the bottom of the bear market and they were buying all kinds of speculative positions to chase it up, hoping real buyers do eventually emerge. Maybe they will. I tend to think they won't. All right, so I think that's pretty cool. You can find that chart on hedgeopia.com and probably somewhere else and take a look at it. All right, what do I want to talk about next? Yes, the upcoming Fed meeting. So the Federal Reserve meets tomorrow. Now, I think last week I mentioned it was next month. I was wrong, so apologize for that. It is. They meet tomorrow, and we'll get a press conference on Wednesday. Now, there's a lot of talk about we're going to get yield curve control. I don't think Powell's going to do any of that. I don't think he wants to do any of that stuff. You got to remember, Powell actually knows that a lot of this stuff doesn't actually do anything. How do we know that? Because he's been on the Fed back during the great financial crisis with Bernanke and Yellen. He's been a member of the FOMC board. So he knows, and if you go back and read some of his minutes from back then, you know that he really doesn't buy into all this stuff. There's another factor about Powell is that he's not a PhD economist. And I don't think he wants to be the guy that does some of this monetary experimentation beyond what's been done, because he can't really back it up with, some book or paper he wrote like, Bernanke was able to. And I'm sure Yellen had stuff that she did. So I don't think he's a guy to do that. Now, what I do think Powell is a guy that understands forward guidance very, very well. And he's used his forward guidance to get people to speculate back on the stock market. And I believe that on Wednesday, he's going to use forward guidance to convince people that we are going to do yield curve control, but we're actually not going to do it. I think he's going to try to do that because he knows, as much as you and I know, from a macro perspective, interest rates have to go down in order to get a recovery. They have to. You cannot have an economic recovery on rising rates when you're in a recession. They have to go down to spur lending growth. We're not seeing it. So that's another way we know from a macro perspective this market is way overcooked. So the other thing that's kind of interesting to me is what's going on in the repo market. Now, if you look at repo, these are these overnight repurchase agreements that the Fed does where they swap Treasury securities with the commercial banks for cash. And what happened is we saw the repo problem growing, and I said, look, when you see repo, okay, what it tells you is the monetary system is breaking and is going to lead to a liquidity event. That's what it tells you. And sure enough, what happened? In March, we had a liquidity event as the repo problem blew out all over the place, and the Fed had to panic. And it looked back in January and February, the repo problem was going away. And now look, it's creeping back up. The dollar liquidity problem never went away. All this quantitative easing didn't solve it. It didn't go away. And so when you look at this repo chart, to me, it tells us the monetary system is still broken. There's still a shortage of dollars that never got fixed, and the Fed's going to have to do more QE. Now, maybe we call it yield curve control. Maybe we just call it something that convinces people what it is and causes them to buy bonds, because that would work. There is a way to fix this without having people buying things and spending, borrowing money and spending into foreign markets. That's called getting American investors to buy U.S. government debt. That would also work, which means they'd have to sell their stocks. Some people say that's not going to happen. We'll see. Who knows? But it tells me in the repo market, there's still a big problem. The cockroaches are still in the wall. You may have sprayed them, and they may have come out and died. They're still there. The Fed thinks they're gone. They're not gone at all. Now, that also gives us the consumer price index coming out Wednesday before the Fed meets. And this is great because what it tells me compared to the money multiplier is that consumer prices are on a year-over-year basis are likely to head lower, because deflation is expressed by the money multiplier when it falls. And so we know consumer prices often and tend to overshoot the money multiplier as it heads down. And so what we see here is consumer price on a year-over-year basis heading lower. And so my expectation on Wednesday will be that we will see a bearish print for consumer price index, and that should help suppress yields. Of course, it also kind of backs up to why did we see this reversal in yields last week? Well, probably because somebody knows what the Fed's going to announce on Wednesday. Now, who would know that? The large commercial banks, because they're in cahoots with the Fed. The Fed doesn't do anything without them knowing. Nothing. They ask them, hey, we're thinking about doing this or that. How would it impact you? They know what's coming. And I have a hunch that this is going to be very bullish for bonds. Whatever the Fed's going to do, it's going to be bullish for bonds. All right, so let's jump in and let's grab some of your questions. Let's do that. And then we'll come back and look at some charts. Hello, Steve. Again, thanks for your videos. You're very welcome, my friend. Have to bother you with another question. I understand that you can lend/sell the same piece of gold to two persons, COMEX paper and not nice. Now, I don't know. I'm not familiar with this, so I can't say that I know that. But if you say that's how it works, okay. I'll go with that. Seems that the same happens with dollars, whereas I don't know. I don't know the answer to the first one, so I don't know the answer to the second one. So whereas the monetary base is the real stuff, that is true. The monetary base is real versus the M2 paper dollars. I'm not sure I understand the question because I don't understand the first two parts. So you can cheat with dollars as you can with COMEX gold paper. Wrong or right? And if right, can you explain? Does that make sense? I don't think you can cheat with dollars in the M2. I don't think so. Not that I've seen. Next question. Hi, Steve. Hope you and your family are well. We are. Thank you. I have a question pertaining to the federal funds rate / treasury yields. What relationship do each have with one another, and how does keeping yields low translate to lower interest rates for consumers? How does the federal funds rate tie into that transaction? Hopefully I'm not too late with my question for the Q&A session. Look forward to your show. Well, I think we were a little too late on that, but never too late. As long as we do more shows. Okay, here's the federal funds rate. Let's overlay 3-month treasury yields. And so what you can see is the federal funds rate is effectively the 3-month treasury yield. So the Fed, looking back at your question, what do they have a relationship with each other? Well, lower federal funds rate means lower short-term treasury yields. So let's go out and add, say, 10-year. Let's see. And what lower interest rates mean when lower Fed funds rate means? It means lower long-term rates. And how about we go out to 30 years? Mortgage rates. Well, we could do 30-year mortgage rates. Yeah, let's do that. And what does that mean for consumers? Lower mortgage rates. So lower federal, persistently lower federal funds rate means lower mortgage rates, means lower interest rates for consumers. So when you go and borrow things to buy things like a home, car, electronics, other big ticket items, washer, dryers, things like that, it means interest rates across the curve, go down. So that's good. Okay, next question. Hopefully let's see, did we get that one? How's federal? It doesn't tie into the transaction. It just sets the direction. So lower federal funds rate leads to lower yields across the curve. Can you discuss what does it mean when an economy is deflationary? Not so much how it gets to be deflationary. You've covered that very well. But what does that mean for people? Does it mean that the price of rice goes down? Yes. Does it mean that the value of the cash in my wallet goes up? Yes. And can I buy more with it? Yes. This is exactly what deflation means. Does that mean property values go up or down? It means they go down. Does that mean loans will become cheaper or more expensive? I don't know about origination fees, so I don't know. I would assume they could become slightly cheaper. I don't know if they do come cheaper. My gut reaction is great. I would love my dollars to be more valued to buy more things with it. That's awesome. That's exactly what deflation is and what it does. I should be happy, right? We should all celebrate deflation. What am I missing? Why should I not love deflation is my question. Seems like a really great thing for everyone on the planet. And if deflation is actually bad, then does that mean that inflation is the opposite and good? Okay, so here's the answer to that question. Deflation benefits the saver. So for example, let's say that you are sitting on a lot of cash and you would like to buy stocks. Well, you want deflation because deflation means stock prices go down. And that means you can buy more of them for the same amount of money. Deflation is bad for the person who's in debt because what it does is when deflation hits, the value of your debt goes up. And you're like, well, wait a minute, how can the value of debt rise? Simple, because in inflation, incomes generally fall too. People lose their jobs. So does your mortgage payment or your car payment go down if your income goes down? Nope. So the whole point of deflation is to benefit the savers. Deflation is bad for borrowers. And since we're at a record amount of debt in the world, deflation from the Fed's perspective is bad. From my perspective, bring it on. I love deflation. Deflation is where you make all your money. As a macro investor over the long term, deflation is what you can't wait for. It's how you make all your money. I started following your weekly briefs on YouTube after a friend put me onto you. I like your no-nonsense approach to the macro facts. Thank you. I ascribe to the financial thesis that we're currently a secular bear market that began in and around the year 2000. With this approach, I am of the thought that the S&P 500 will end up returning to its 2000 year in value, give or take a couple percent. Ooh, that's a fun question. Let's go look and see what I think, as I think we're not far off in our opinions here. So here's the 2000 peak. It's also the same peak as 2007. Puts the S&P, say, under 1600. This is a major line of what's called support, where previous buyers were at. I think we could see a bottom in this secular bear market between 1200 and, say, 1550. So I totally would agree that coincides with my opinion. Hope you're well. Seems like a V-shaped graph for the spider. Is that a false recovery still? The answer is yes. As we previously discussed, this is a false recovery because this recent rally is built purely on speculation. Purely on speculation. So while we're here, let's go take a look at a couple of charts. Of course, my favorite one, TLT. The kind of question is, why do you love bonds so much? Because they're in a bull market. And from a macro perspective, remember, when interest rates lead the market lower, what will eventually happen to stocks? They will follow. So, bonds it is. All right, let's take a look here. So we had TLT get sold off the 30-year curve. Everyone's like, aha, inflation's here. No, it's not. It's just something's coming up at the Fed meeting on Wednesday, and somebody wanted to buy some of the supply up. And look at that. It came down, tagged the bottom end of this support channel. And in today's trading, came up. Well, that's not a very good picture. Here we go. And in overnight trading, it came down, retested this dotted purple line, which is support, was resistance, retested it, and then kind of rallied up, headed toward the upper end of the support line. And as I mentioned on Friday's video, when this thing does tend to move between zones by supply, what are called supply zones, where buyers and sellers intersect. So we know that buyers are here, sellers are up here at the moment, that they tend to move very quickly because there's not a lot of people in between here that are buying and selling. So when this breaks out, I suspect this will move quickly back up into here, and possibly we'll see that on Wednesday. So I'm very interested in that because I did not buy into the fact for a moment, based on the economic data, that this was anything more than a speculative move higher, or a move that got allowed to go higher as buyers stepped out of the way because they wanted to buy more bonds up here. We'll see if I'm right. How about gold? We haven't talked about gold in a long time. And remember, this thing is rolling over. We're seeing the speculative positioning come out of this. And what's very interesting to me, it could very well, at least from the mining, this is a GDX, the large gold miners. I like looking at this more than I do the physical metal. It tells me that it would not surprise me that we see gold miners come back and tag in this major now level of support down here, the $19 to $22 range. And that to me would be very interesting. Again, this move here, speculative. This is all just speculative moves. A question did come in about emerging markets. Do I think this is a major breakout? We'll get to that question probably later this week. But no, I don't. Actually, I do. It did break through the line of doom, but are we seeing any sort of reflation other than speculation? No, we're not. The macro data is not telling us we're at the bottom. The repo operation data is not telling us that the problem's solved. What we see here is just money flooding into stocks and sellers not interested in selling. So that to me gets reversed and potentially creates a much larger move down in EEM and a much bigger liquidity problem than we actually saw in March. At least that's kind of what I see it as at the moment. I think things are not as rosy as the market suggests they will be. So we'll come back on Wednesday and we're going to go over the Fed meeting, because there's probably going to be something pretty interesting to go over that. We'll look at the CPI data. So one thing you can do, follow along from the macro perspective, is watch the CPI data coming out from China. That is usually a leading indicator, because remember, if they're an export nation, so if they're manufacturing mugs, right, and their exports prices are going down, well, guess what the value of this mug is? It's declining. Now, when that mug gets to the United States, when I buy it, does it magically go up in price because it went down in price from the supplier from China? No, usually the decline in prices gets passed on. So we already know that China's been exporting deflation. It kind of tells us ahead of time. We already know where the CPI is headed. Also helps the CPI is about 6 month lag behind reality. So we have an idea of where it's going to go. Anyways, thanks for watching. Thanks for submitting your questions. If you do have a question for the show, you can send me an email, you can send a message on Facebook or a message on LinkedIn. And as long as it's not trading advice, we'll be sure to try to, or there's something else. I always forget what the something else is, but as long as it's not me interpreting someone else's research, if you do have a question about someone else's research, put it in your own language, send it to me as a question, but don't say, hey, here's this video, article, or thing, could you read it? Or, hey, there's this piece of it, could you give us your opinion on what so-and-so says? I cannot. However, if you can frame a question in your own words, I'd be happy to take a stab at it. Anyways, I'm Steve Van Metre. Thanks for taking time to watch. We'll see you back on Wednesday. Bye now. The content of this video is provided as education information only. It is not intended to provide investment or other advice. This material is not to be construed as a solicitation, recommendation, or solicitation by selling security, financial product, instrument, or to participate in a particular trading strategy. This video was prepared by Steven Van Metre. Personal capacity opinions expressed in the video that do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.